from Chris's wealth of experience. Get Pulver alerts now.
Good morning, everybody. Happy Tuesday. How we doing? Taking a look at the markets today. Interesting price action with the futures market. We had a huge gap up in S&P futures and Nasdaq futures. I was actually looking to see if I could fade that. I just thought, we got the Fed tomorrow. I don't know what's really going to happen. So I did this instead. I'm going to add in, and look, in my Pulver alerts, I've had several new alerts go out that have been hedges. If you're in my Pulver alerts, you check the index positions. So I put in a new trade on the QQQ for January, a new trade on the SPY for January. Today, I'm looking at an even cheaper one. I'm just going to go index. It's really simple. I'm going to add this in right now. New trade, SPY for the 31st, 350 put. I paid 11 cents debit. This is a hedge. If price on the SPY falls somewhat quickly, this cheap, out of the money put can pay 50 cents to $1 credit for a nice gain. This is part of my ongoing small hedge plays for bigger payouts. Okay, so it's not even a level that I'd say we're going after. It's more just taking advantage of the inexpensive options chain. So I'm putting that in the Pulver alerts right now. I added that in this morning. It was 11 cents on that debit. I bought enough contracts where if it pays me, 50 cents or $1, it's worth it. It offsets my portfolio by about $10,000 to $20,000, depending on the movement of the underlying. But it was weird to see, this gap up right around, 4:45 to 6 p.m. That's always kind of that futures hour. There's no trading, but we had this huge gap up. So the first thing I did is I wanted to see, well, hey, does that translate into the S&P? Nope. We were trading like $2 lower today on the SPY pre-market. We're lower on the Qs today. We are continuing a gap lower down to the 50 moving average on the Dow. This has been one of the worst streaks since the 80s on the Dow. The RSP, which is equal weighted S&P, this is now 11 going on potentially 12 candles in a row. Again, just showing like this market is not market breadth. This is concentrated with large cap market weight and Mag 7, throw in Broadcom, Mag 8, I guess, whatever you want to call it now, all your $1 trillion companies. We've got equal weighted down, 11 days in a row. So if this finishes red today, that could be 12. Is this a bad thing? No, I mean, I'm still looking at, so I have some exposure here. If we come back to the 200 moving average, I'm going to buy some more here, And so if equal weight is going lower, I do wonder, does that ultimately drag the SPY down? Because I don't think we can have the SPY going up and equal weighted going down and not have there be some type of reversion. Either the equal weight starts to catch back up, or the the market cap weighted like the SPY will start to center and come back down. Okay. All right. Let's have a look at everything else. Bitcoin's up to 107 right now. I was actually taking a look at, I used to have some GBTC, that grayscale Bitcoin, and I just saw they're offering BTC. So it's like grayscale mini, and they lowered their expense ratio quite a bit. So, I don't love the way this one looks. There's obviously not a lot of price history. It doesn't look at all like Bitcoin, but this actually is through Grayscale owning Bitcoin with an expense ratio that is way cheaper. So a 0.15 expense ratio, if you take a look at IBIT, which is BlackRock, which is obviously widely adopted, their expense ratio is 0.12. And this chart looks an awful lot like Bitcoin. So either way, just considering some more diversification, it's obviously cheaper. BlackRock $60, Fidelity's in the 80s. Bitcoin itself is 107, but you can dollar cost average whatever you want with your wallets. So MicroStrategy, I just read that Michael Saylor bought another 15,000 Bitcoin, or like MicroStrategy bought another 15,000 Bitcoin valued at like $1.5 billion last week. So they're continuing just to add to their hoarding of Bitcoin. And we're at 106. We've got MicroStrategy at 392. I'm kind of interested. Actually, you know what? I think I'm going to throw in, well, we'll see how volatile MicroStrategy is. If this is high, low, lower high, lower low, let me measure that just in case. I'm going to measure this move and possibly have a couple of small dollar cost average levels in. But let me go ahead and box this in real quick. So if I take a box, start from the high, so high to low, and then project that right here. So symmetry back to him on 240. If I take, let's say, $1,000 right now, and then another $1,000 down here, I'm okay sitting on that. Now, expect a lot of volatility, right? I mean, could this come all the way back down to $200? Could this ultimately be declared like, oh, MicroStrategy is too much like Bitcoin, and it's I don't know. It's all speculation, but it's risk capital. So, but because this is trading as kind of this like front running proxy to Bitcoin, we're at 106, 107. We're hitting some symmetry on Bitcoin. I think if we have a pullback, it would make some sense. If I put a small dollar cost average in level there, so I put 1K in, I put another 1,000 in, that gives me a break even there at 2K. Can we get back to the highs? And let me just do some percentages here. So let's say I get a dollar cost average level there, and it goes up 70%. Okay, so I can turn a $2,000 investment into, a $1,000 profit. That's pretty good. So I don't mind that. I don't mind that at all, actually. Let me see if I can get lucky on, you know what? I'd like to throw $1,000 at it, but I'm going to go ahead and pick a price point. I'm going to go 372.50. How many shares can I get? Not very many, but $1,000, 372.50. I'm going to go 3 shares. Okay, so 3 shares of MSTR. Let's go positions, trade, going long stock, going 3 shares for a dollar cost average, and 372.50. See if I can pick up a level there. And that would put me out $1,100. That's fine. Okay. So I'll toss a little bit out there. 372.50 pending. I'm going to put this in for all my accounts. I'll throw this out for a Pulver alert as well. Okay, just give me a second here to get all these filled, or pending rather. Okay, almost there. All right, so that is pending. Stocks options, this will be new trade, MSTR, $1,000 buy-in at 372.50. 3 total shares. I guess it's technically an $1,100 allocation. And the other level I would put that in at is around 240. And how many shares can I get for that? If I put another $1,100 at 240, I'll go 241. I get 4.5, 4 to 5 shares. This is a dollar cost averaging for BTC exposure through MSTR. Michael Saylor continues to buy BTC, and the stock itself has traded on the positives and negatives of BTC volatility. If MSTR hits 1,000 per share, I'll be happy. Okay, so let me add in the 372 level. 372.50 is right in here. And symmetry around 241, right in there. So 372 to ups. 372.50 and 241. All right, take a screenshot of that. Okay, that's going in Pulver alerts for the Discord. Sending now. All right, that's MSTR. So a little bit of action there. If we get filled, great. Let me set a chart alarm. Move this one up to 372.50. Level 1 for MSTR buying, just so I know. Okay, so we got some of that. I was looking at doing it's a zebra spread. That's a real thing on BTC, that grayscale mini, but I don't really have enough price history on it, so I don't know. Actually, it wouldn't be terrible. But it's going to cost me like $2,700, so that's why I'm not doing the trade right now. I'll pick like the little $1,000 increments and take my stabs between IBIT, FBTC, MicroStrategy, Coin, plus my Coinbase wallet. I've got enough exposure for right now. I have it in my personal accounts. I have it in my retirement accounts. I've got dollar cost averaging going into a wallet as well. So there's some exposure there. It's been a pretty good year on old crypto. Anyway, let's talk other stuff. So S&P, where are we at? We're sitting here with a, these are the levels I keep talking about. Okay, so you want to write these down. So SPY would be the equivalent of roughly 608, 609, 610, and 602, 601, and 600. I think we are dealing with some market maker levels that are going to keep prices contained until we have the Fed coming out tomorrow. Okay, so tomorrow afternoon, 2 p.m. Eastern time, rate decision, which is all pretty much priced in. The Fed's going to cut rates another 25 basis points. Two things that are really important. In my live session yesterday, let me show you this. I talked about this in my live session yesterday at 3 p.m. So I did a YouTube session. I put together some visuals. This actually, I pulled these from a podcast that I listened to this weekend that I thought was really interesting. I just expressed yesterday like how high sentiment was and how bullish everyone is. Everyone is pretty much just crowded to the boat of we're bullish. Everyone's bullish, and so man, I'd like to see a little bit of a pullback. I'd like to see a little bit of a shakeout. I'd like to see some portfolio rebalancing. We may not get it. It may not be until like February, March, April, May. I don't know. It might be end of the year. The Fed might do something to break the market down. I have no clue. But I'm going to keep taking my cheap edge plays just because. And but we are sitting here at sentiment levels we haven't seen since the 80s. We're looking at Warren Buffett loading up on cash when, look, it's not like the timing is perfect for Warren Buffett ever, but the guy raised cash right before the dot-com bubble. This is Berkshire Hathaway's cash allocation as a percentage of assets, and it's never been the highest ever, which is nuts. So Berkshire Hathaway raised cash years before the dot-com bubble. They raised cash years before the financial crisis, and they're at the highest level of, cash allocation or percentage on hand ever in the history of that company. So Buffett is fearful while others are greedy. The saying. The timing could be, 12 to 24 to 36 months off. But at some point, I'm sure, look, Buffett's 94. If the guy's around for another 3 years to see another crisis, he's probably going to be happy they saved cash. If I do wonder what happens to Berkshire Hathaway if he passes away. I don't know. I'm sure their methodology and their philosophy on investing and value investing, I'm sure it's okay. But if all of a sudden he passes away and they're like, Berkshire Hathaway crazy into Bitcoin. That would be, that'd be an interesting switch. Anyway, but he's raising cash like crazy. Here is leverage ETFs. We're getting up near these levels we saw back in 2021, which I don't think is a mistake. That everyone was levered up on ETFs, and we had a top in late 2021. So we're kind of matching those levels now. Sentiment stretched to the highest levels we've seen in the last 12 months. Futures positions higher than where we were back in 2021. Leverage ETF bets are higher than they were back in 2021 and 2022. Risk appetite is pegged to these 100th percentile levels in a Goldman Sachs sentiment survey. Everyone is crazy exposed to stocks right now. Mutual funds are highly correlated to the S&P, and they're also, super bullish. Retail sentiment is ridiculously bullish. Like this is going back to 1990, and it is parabolically higher and more aggressive on speculative positioning. So you got a retail crowd that is just dumping money into these markets, and again, you dump money in, there's clearly like a melt up effect, and that's what we've seen since the election. But I just don't know how sustainable this is. And that retail traders typically, when they get in late, they're left holding the bag. Now, it may not be like a crisis, it may not be like a crazy bear market, but it hopefully is going to be some type of healthy shakeout. I keep saying 3, 5, 7, 10% corrections. Again, sentiment levels highest since the 80s. Risk appetite coming like crazy. So anyway, that's where we're at. All right. And to what degree? I made a little claim yesterday in the SPY. Up here, I said we will likely find this 200 moving average. So if I zoom my chart out, I think we're going to find this 200 moving average before we hit 10% higher. So from yesterday's timestamp, this is 10% higher, and this is roughly a 10% correction. Now, if price goes nowhere, right? Let's say price goes sideways, okay? And this allows all my moving averages to catch up. Well, there could still be some dynamic support in here, and the market tries to eke out some gains, but we're now stretching into like the 280s or 290s on the bar count. I would not be surprised if we find this moving average, whether it's like sideways or maybe a little bit down, to find some support and then get back to these highs before we hit another overstretched melt up another 10% up. So, and I think, look, if the S&P can't go any higher, I don't think the Nasdaq is going to continue to operate on its own island like it can't be stopped. That's what's weird about right now is like you're seeing all these odd correlations. You got S&P flat, Nasdaq up making all-time highs, Dow's down to one of the worst losing streaks we've seen since the 80s. RSP potentially facing, which is equal weighted S&P, 11 days in a row bearish, and today would be 12, and it might close the gap today to show a green candle, but it's not really looking great, right? Look at this. This is 12 candles in a row to the downside. Like this has never been seen before. So are we representing, the broader markets well? Is it, nicely correlated? No, not at all. It's completely segregated and completely disconnected. So somehow the market's going to have to figure out what, balance looks like. And if we're being led by equal weighted, it's going to weigh. It's going to weigh on the Mag 7. Mag 7 clearly can lift the SPY and the Qs higher as it's done. We see crazy amounts of order flows going into it. I mentioned yesterday in my live session, like 70+% of interactive broker flows this year have been pretty much Mag 7 related. Like for their retail traders, everything going into their broker platform is 70% Mag 7. That is crazy high concentration. Yes, it's been working. I'm not saying that it's a stupid trade. It's a great trade. It's been killing it for a decade. But at some point, it's got to get, it's got to get some type of reality check. And I think we're close to that level where we've had, I think, 2 or 3 kind of windows of like broad market, and now it's not. It's like right back to 10 stocks carrying 490 stocks. Equal weight is crap on the QQQE. Equal weight on RSP is crap. Russell is down. Dow is down. So interesting markets and interesting times. Here we are looking at, the SPY for the last 3 weeks. We have a high and low, and then we have a week that kind of traded inside that. We have a week right now. It is getting narrower. You gotta admit, like getting a little bit narrower, having some equal lows in here doesn't mean this is a bear pattern. All right. Doesn't mean this is a top. It just means that price right now is indecisive. Now, like I said, take this to the SPY, the 60, like 603, 602, 601, 600. I could see some bounces coming in there because that's previous resistance becoming support. If the bull market's going to stay intact, I think we have to bounce hard off of this, 600 level. We're currently trading on the SPY at 603. Okay. So does it bounce? Sure. Does the Fed save anything tomorrow? Maybe. If we're going to see all-time highs by the end of the year, we're probably going to have to see some Fed love. Jerome Powell says the right thing, or price action ultimately moves like he said something great. One thing you can notice for today is that we do have a gap to fill. And so if the market's coming back down here to 600 and we find that gap by the end of the week, I wouldn't be surprised. That could actually be a very cheap trade. Actually, I could go out of the money call. Is it cheap enough to go out 2-3 weeks and see if that gap gets filled by the end of the year? Obviously, it got to be dead wrong, and we could break below 600 or break below 60.18, which, if I go back to, not sure if it's on this chart, none of these charts, maybe I didn't put it in here at all. I think I might have a screenshot of it still, maybe not. Yeah, these levels, nope. I don't have it. No, I've got too many screenshots. Doesn't matter. I was just calling out some levels like the SPY has to stay above 600 for me to kind of maintain a bullish push. This is the 21 moving average right there, previous high. If we bounce off that, okay, fine. If we break below 600, then we bring in this 50 moving average, which is around 590. I have a 608 by 590 running right now. Okay, so if we break below 600, we get to 590. That bear put spread can pay me $18 for what cost me $4. That's a pretty good hedge per contract. Okay, my QQQ, if that turns over, I did a fudge, I don't remember, 533 by 510. 533 by 510 cost me $5, I think, or less. It was like either $5 or $4.85, but it's offering me $23 of credit. So again, like pretty good reward to risk if I'm right. So cheap hedges for right now. Melt up is fine, and I'll keep just fighting the good fight. Okay. But I do have a lot of cash at the ready. I'm waiting to deploy that cash at better levels. I'm trying to be patient. The one trade I'm interested in watching this week will be NVIDIA, which is also into correction territory. We're now crossing double digits from the highs. So NVIDIA is down about 16%. Okay. Now, you could argue 20% is a bear market, but that's mostly for the indexes, not for individual stocks. This had a crazy correction of 40+% back here, 35%. So 35% correction back in July to August. Now we're back to 16%. And like I said before, this is back on December 10th. NVIDIA hits the 200 moving average before it hits all-time highs. So I have a trade right now, this guy, that I'm willing to take the assignment. If price this week is below 130, then I'm going to take on 100 shares of NVIDIA, and I'm going to repair this thing with the intention of trying to get $5 to $10 per share. Now, I'm probably going to get that not necessarily by the price going up, but by me selling premium and selling calls and lowering my cost basis more aggressively. So obviously I'd like to make, $10 a share and make $1,000 and walk away and have an income trade, even if this thing goes sideways or goes down. So my goal is to try to lower the cost as much as I can, back down towards this 200 moving average, and then try to get out of the way for a nice little recovery. And then I can add some more premium to it and lower my cost basis. Maybe I can make more than $10 a share. But this is going to be a fun little income trade. I accept the challenge, even though it's going against me right now. I don't get assigned until end of week. So if price on NVIDIA gets back above 130, then there's a sweet spot here. If we're greater than 130, okay, we're greater than 130, but we're less than 132, then I actually walk away with $4.57 credit per contract, because I'll keep $2 on the long put, and I will get the sell premium on the 130 and not get assigned. So that's my best case scenario right now for this trade. If we're below 130, then I'll keep the shares and I will repair it. So I'll put in repair. And then I'm just going to turn it into essentially a covered call strategy, and I'll lower my cost basis and try to make, I'm going to try to go after $10 a share. I can't scribble today, but I'm going to try to go after at least $10 a share and turn 100 shares into $1,000. Okay. Now, and I could make more. I mean, if I have 100 shares and we go from 123 back into the 135, 140 level, but point is if I own it at 125, I lower my cost basis to 120, we get back into 130 plus. I can always add like an in the money covered call and just work the numbers where it's like, okay, hey, I'm going to get, $14 net credit if it gets called away. Well, I'll make $1,400 on a, margin position that's going to cost me around 7 grand. That's pretty good. If I make, let's say I make $1,000 on $7,000 margin, it's 14% return in maybe 2 to 4 weeks. I take that, you know? So not trying to be greedy, but if I can do a lot of repairs, and this is what a lot of my like ownership looks like. If I own it, flip it for $500 to $1,000, that generally translates into about 10 grand in my portfolio. So for every $10,000, if I do that, I don't know, 50 times in the year, 100 times in the year, like it's pretty simple. That's just a nice little income strategy. So, and then a lot of trades that never get assignment, and I just continue to grind some income trades without ever having to own the shares. But Nvidia, I'm gonna stay. I'm team Nvidia right now. It's still kind of the head start. I know there's going to be heavy amounts of competition moving forward. Is Nvidia's reign done? No. I mean, look, it's Mag 7. It's the leader of the semiconductors. I think that it's beat up for a little bit. I wish Jim Cramer would keep his mouth shut on it, because him saying like "don't touch it yet," maybe that means it's going to go up sooner than later. you know, that guy is dead wrong. I don't know why they keep giving him a show. Actually, he should just go off air, not do Mad Money anymore, and maybe you'll be happier traders. But no offense, Jim Cramer, you're cool. But just nobody likes how you trade. Same thing with Kathy Wood. All right. Anyway, that's where we're at. So Tesla. I would love so same thing on MicroStrategy. I've got some dollar allocation levels on Tesla. I would like to see a pullback towards the 21, the 50, anything on Tesla. Doesn't mean I'm calling the top. Just means that I want to see if this pauses and pulls back. I'll look for some pullback levels to get in on Tesla. Look, I think that this is kind of staggering. I saw this in Opening Bell Daily today and Robinhood Snacks. I think like 80+% of this year's gains in Tesla came after the election. That is insane. Like the rip that this saw is completely abnormal. I mean, this thing spent like months and months and months building up a wedge, building and giving us nice technical patterns, and then just erupted through the election. And we blew through those all-time highs. So yeah, let's see if we get a pullback. Something like that would be great. Let's see if we get a pullback towards, okay, we've got this big run from low, high, higher, low, higher, high. Can we get some type of pullback? Some type of like Fibonacci pullback, anything that would make some type of sense on the technical side. And if so, I'll get some dollar cost averages in Tesla. But I'm bullish on it overall. I mean, now that we blew through these highs and we didn't really stall at 415, then I could see Tesla, creeping up into the 500s in just momentum. I could see Tesla, with enough bullish momentum to get us up into, 600 plus. Wouldn't be surprised in a stock like this if we get back into $1,000+ before we see another split. Right? I mean, look, I know Tesla trades where it's not just the stock, right? It's not just the energy, it's not just the batteries, it's not just the disruption in the auto industry, but it's also Elon Musk. And like him or hate him, there is a lot of what Elon Musk gets for his own personal sentiment, and that trades very closely to what Tesla's given us. So the fact that that guy is like, 1 degree of separation essentially from the president of the United States in 2025, it's probably good for the company, right? And it might be a big thing for EVs. It might be a big thing for Tesla alone. I have no idea. I don't think there can be some type of exclusive thing where like Tesla just becomes like the greatest automaker in the world, because it's not. But it'll be interesting to see how price plays out and how much sentiment gets into it. But it is, I don't know, it's a little overbought. I will say that. So anyway, but look, a lot of traders have been happy, right? You've been long on Tesla. You've been freaking smoking it this year. And I saw an oldie but a goodie. This is an old Trading Battle shout out, but somebody was asking me like, what are my favorite picks for this year? And Tesla was one of my favorite picks because nobody liked it. When Tesla was trading down here in the 200s or sub $150, I was like, nobody likes Tesla, so I'm buying it, and that worked out pretty well. So anyway, it is what it is. All right, let's take a look at some other stuff. I got some currencies I like to review. A couple things I keep talking about. Watch your 10-year yield. This week with the Fed, especially cutting rates. Just going to say it. If the Fed cuts rates on Wednesday, which they're probably going to do, and this thing goes higher above 4.5, that's not a good sign. Okay. We also have core PCE on Friday that's expected to print. I don't know if it came up in the calendar yet, but let's find out. Bloomberg calendar for this week. Friday should be core PCE. Wednesday is the Fed. Here's your 2:30. 2 p.m., 2:30 press conference. Okay, there's another 25 basis points cut. This is showing up as 4.25 to 4.5. That's going to be that window for U.S. rates. And then core PCE on Friday. I didn't see any forecast for it. Let's see if it shows anything for today. So this is Friday, 8:30 a.m. Retail sales for CAD, PCE still don't have. I mean, that's so weak. You can't get a freaking forecast on the calendar. I don't know if that's by design. I mean, you see like the month over month is forecasted. Okay, fine. That just means a higher price at 0.2%. Core PCE is the number that everyone's going to be watching for the core PCE year over year. What I read this weekend is 2.89 is going to be the forecast. So if it's printed previous at 2.8 and it goes up to 2.89 or 2.9, that means higher core PCE. That means higher PPI. That means higher CPI. What does that do to our 10-year rate? I don't know. Okay. Yeah, but I'm not looking for the month. I'm looking for month over month. I'm looking for year over year. Okay. All right. You want to see? Here's some numbers for you. Here's the last 4 years. We've been operating at 4+% inflation since 2020. This is what everyone feels. This is why inflation sucks. And the last 4 years, here's some numbers for you. Okay. Medical care is up 9+%. Apparel and clothing up 12%. Used cars up 17%. New cars 19.9%. Okay. Even though these have come down in recent months, here's the 4-year running total. This is why life feels more expensive. Used cars 17.4, new cars 19.9, food at home 22.9, shelter 24.2, food away from home 25%, electricity almost 30%, gas utilities almost 30%, transportation up 40%, home prices up 43% in the last 4 years, gasoline up 47.5, fuel oil up 50%, auto insurance up 61%. This is what we deal with. For the last 4 years, this is life getting more expensive. So don't tell us that inflation is coming down when it's not. Like it might be softening or it might be going up at a slower pace, but it's not getting better. So all these measurements at some point, I don't care how much household equity people have. If there is a blip in the housing market where house prices start to come down because everyone that wants to sell is trying to or being forced to lower their prices, everyone wants to buy is not going to buy at high interest rates. You're going to see inactivity. You're going to see, residential construction numbers going down. That could be enough to also be one of the many things that would be piling into like, how is this market going to have a correction? It could be a consumer, right? If the consumer is overstretched, which I believe they are, and this household equity that's been built up and the 401ks and all the all-time highs in the markets are all of a sudden starting to show signs of waning, it doesn't take much. I don't think you understand how fast a correction can happen. As much as we've had this great run for the last 2 years, think about it this way. Okay, look at the S&P, okay, over the last couple of years. So let's take this bottom and let's just say we have some wave structure here, all right? So if we go low to high, higher low to higher high, let's take this last stretch, this low to this high. Would anybody be surprised to see this market pull back? Let's just drag a Fibonacci on this. This is all hypothetical here. But if I take this last low to this last high, would anybody be surprised to see some type of, even if it's shallow, 23 to 30% pullback? Right? If it's the 23 to 30% Fibonacci retracement level, those pullback levels would be fine. They wouldn't do anything to damage this bull market, right? They'd still be dynamically supported on the daily time frame. But you got to wonder, like, where does this market pull back? And based on this low, this high, look at where my 200 moving average is on the daily chart. Like, I keep saying this, but I think we find that 200 moving average, right? So just saying, don't be surprised with as fast as we've gone up that we can have a shakeout. It doesn't mean it's the bear market. It doesn't mean it's the end of the bull market. It just means that it's just a dose of reality to kind of get people that, I don't know, don't deserve to be long and being proven right. It's the bull market geniuses that have like, I'm levered on this and I'll kill it. I can't ever lose. I expect to make 30% a year in my portfolio. It's that little slap in the face that those people need. And that's what the market usually is glad to offer. So just be ready for it, you know. And going into the Fed this week, we'll see what we get. I continue to see a lot of market maker levels here in the low 600s that I think the market bounces off of, and here at the 608, 609, 610 level. But if we break below, okay. If we break above, okay. I don't know where price is going to go. I don't really care. If it goes down, I have hedges. If it goes up, that's easy. If it goes up, that's the melt up. May it continue until, it never pulls back. This market never pulls back. Easy. But if it goes down, I'm ready. Right? And how much am I risking? I don't know. Probably 0.5%. Right? 0.5% that could pay me, somewhere between, let's say, 2.5% in gains to maybe even 5% in gains. That would be a worthwhile hedge if I'm right. So I'll keep playing those. If we go higher, that's easy. But I'm telling you, tomorrow with the Fed, we should be watching, and we'll make reference to this tomorrow afternoon in our bonus session. I will be watching this. The 10-year yield has done the exact opposite of the Fed, right? So the Fed cuts, and what does this thing do? Go higher. The Fed sees higher inflation and cuts again, this goes higher. So if the Fed cuts again and this goes higher, this is another reason to be cautious in the first, 3 to 6 months of 2025. This was a breaking point for the market at 5%. Okay. Everything that fixes on 5 to 10-year borrowing, okay, mortgage rates, especially 5, 10, 20, 30 years, I mean, anything that's financed in the medium to long term is going to be based on a 10-year yield. Okay. So if this goes higher, how would you like to see that the Fed has cut 100 basis points and yet your borrowing cost on a house is now 1% higher? The Fed cuts 1% and your mortgage rate's 1% higher. Makes perfect sense, doesn't it? But that's what we're about to deal with. So keep an eye on this. On top of that, the 10-year and the 3-month is at the zero line, and this is officially disinverted. Every time this has happened for the last 40 plus years, it is borrowed time before we face a reality check. Okay, and that reality check is recession. But on a silver lining, the recessions that we've had in the markets don't necessarily always equate to lower stocks. Now, in this example, sitting at all-time highs with crazy amount of overextended sentiment, I would think that we're probably going to have a correction if we have a recession. If anybody is right, and I mean, we've had everyone for 2 years say, we're in a recession, we're in a recession. It's apparently not a recession, doesn't really matter. But my point is, what does it look like? Is it a Main Street recession when Wall Street doesn't pay any attention to it? Yeah, maybe. I mean, Main Street's essentially felt a recession for 4 years with crap getting so much more expensive. I just rattled off those numbers. Everything is 10 to 40, 50, 56% more expensive. Auto insurance 60% more expensive. Are you freaking kidding me, man? It's like $1,000 a month to have a car now. Like car payments are financed at like 8+%. If you're leasing or you're buying a car, you're getting loans at like 8 to 10%. Your car insurance is 60% more expensive. You can get like a basic car. It's going to be like $1,000 a month. It's crazy. So anyway, whatever. Stuff to watch. I keep going back to this, but I guess I'll shout it enough. And at some point, I'll either be right or I'll just keep melting up with everyone else. I'm just not going to participate aggressively in the melt up. I'll say that. So maybe you make more money than I do in the interim. But if I'm on the sidelines with some hedges and they work out eventually, great. If I enjoy the melt up like everyone else, I'll enjoy the percent to the upside. So I'm trading it both ways. It's just, I don't want to be blindsided. I think a lot of people that are, just overextended, heavy amounts of leverage, this market can't go down. It's like, look, people jumping in that have been on the sidelines and jumping in post-election, not great timing. I mean, if you've been with us for the last 2 years, we've had a pretty good bull market, and typically like bull markets, yeah, they can last a while, but you don't see them go straight up forever. So I think people jumping in off the sidelines now are just a little bit late to timing this, but if they have a horizon of 5 or 10 years, they'll be fine. But it's just that like short-term reality check where they dump all this money in, they get over leveraged, and all of a sudden it's like, yeah, the market pulls back 5 to 10%. And it's just a little smell and salt just to make them wake up a second. All right, let's do this. There you go. Sarah says we have 2 cars spent over 2K total. Exactly. It's exactly right. So it's just crazy stuff. All right, here we go. Let's go currencies. DXY, gold, silver. I'll talk about that. dollar index, I still think we're range bound. I still like, I think this dollar could be like eerily sneaky. I mean, I've said this before, this is kind of repeat analysis, but right now we have interim levels right here. Either this 108 handle holds or this 105.50 level holds. Like 105.50 is my break to the downside. If we're not going to break that, if we're greater than 105.50, I'm still bullish on the dollar. Okay. 108 is a potential resistance point. But if that breaks through, we come all the way back up towards this 109 plus handle. We might hit a round number at 110. This is the surprising move. If we get all the way back to 114, that's a really surprising move. Okay. Just look at it this way. This low, okay, and we took out all these highs. If this is in any way, shape, or form giving us some type of bullish pattern, don't be surprised if this market measures this move and gets us back up to this 113, 114 handle. As I said before, this is very disruptive in the Forex market. If we see another, let's say 700 points on the DXY, and that translates into pips. If you've got a 700 pip move on the euro, we're going back below parity. Right? If you've got a 700 pip move in the Aussie New Zealand, you're going to be at like 15 to 20 year lows. We're going to go to like post Brexit flash crash levels on the pound US dollar. If we get a 700 point move on the DXY, it's going to be crazy. The only thing that might be different and non correlated might be the dollar yen because the BOJ does whatever they want. But if this happens, that would be extremely disruptive to the Forex market where, look, it's a flow that I wouldn't want to fight, but it would be ultimately a fantastic way to then have some short-term strength in the dollar. You can ride that thing out as long as necessary. And then if we find a topping pattern, short the living heck out of the dollar and make a fortune. And that's usually how I trade. It's like I might not get this area where I'm super aggressive and active because I don't like it. But if we start trading into open space where this is a big resistance level and we've taken out and we swept all these recent highs, if all this is, okay, is a buildup and another accumulation zone for this dollar to go higher, okay, we could turn this into like a three-wave move. This could be 1, 2, 3, 4, 5. This could be a five-wave move to finish this thing out. I don't know. But when this is done, I'm looking at probably an easy ABC correction, sell the heck out of the dollar, make a fortune. If we get a three-wave move, there's going to be plenty of opportunity to be long the dollar if it's proving to get, I don't know, looking to build off like 105.50. If we find support at 105.50 multiple times, you can stack up your breakouts, you can get proven to be right, and then see price go up. But don't be surprised to see dollar strength. Just saying. Okay. Have you noticed that the yen, I mean, yeah, but who cares? I mean, does anybody trade the yen and make money? So, I mean, these last couple of weeks, I mean, here's the best way I trade the yen. This is the only trade I'm going to take in the Japanese yen. I'm not touching the currency market for the Japanese yen. I will take defined risk all day, and I'll trade it in the Japanese yen futures. So if we come back down into these lows, I will be looking at a long position on Japanese yen futures. Right? And why would I do that? Because I can do defined risk trades. Here's what I like about it. If I trade options on Japanese yen futures, I can get in around this area where I would say technically I'd like to be in. And this Japanese yen can get super weak or it can get super strong. I can define my dollars and percents here and take a trade. This is way better for me than trading the Forex market because the Forex market will test these highs and lows and it's going to run these liquidity levels and it's going to be super messy. It's going to take months and months to play out and eventually you get a move. But if you get beat up and you can't survive that, you're going to get your butt kicked. So I can place a trade with no stop loss. I can just trade defined risk options and this thing can go down to zero and the Bank of Japan can have a currency that goes to zero. Or this thing can go up and be the strongest currency pair in the world and I'm only going to risk the same dollar and percent that I put on the trade originally. I am totally fine with that. So I get the ability to truly define my risk, and this asset can be way off, price-wise higher, price-wise lower, and I'm not risking any more than what I predetermine in the trade. So that is the only trade that I'm interested in on the Japanese yen. It's going to be a futures trade, and if it comes back down to these levels where we saw some deleveraging back in July and August, then I'll take another stab at it, right? And what's my timeline? I probably go out 6 to 12 months. And hope that I'm right, you know. and maybe I can say 3 to 6 months and try to be right there. I also, I mean, if I could trade like micro Japanese yen futures, which I don't know if there is that. Let me see if there is a micro Japanese yen. I don't think there is. MNQ, no, that's not it. 6J, I don't think there is. I don't think we have any micro currency futures. /MJ, nope. 6. Okay. Micro Aussie, micro pound, micro euro. Son of a bee. I don't have micro Japanese yen. Crap. So I've got micro Aussie, euro, and pound. That's fine. It's probably, I don't know. I was going to say, like, it would be a better trade for me to trade a micro Japanese yen and trade a long put, or I'm sorry, trade a long call. And the most I can lose is what I pay for that. So if I paid, let's say $250, right? Here's an example. If I got in here for a defined risk of $250 and this thing went up like it did during that July, August volatility event, that would probably pay, I would say $2,000 or more. That type of move and that type of volatility, you would turn this into a monster winner. But if I do it defined risk, then the expiration comes into play and I've got to time it out. But, if I technically get a bottom, I'll be fine. I just wish there was a better way to trade that doesn't cost an arm and a leg. So if I did, I'm just going to look at it right now. If I just did /6J, okay, and I look at something, I'll just say March of 2025. If I buy an at the money put, if I buy an at the money, at the money call or one strike out, I mean, I've got to risk $1,500 on a futures contract. Now that's the most I can lose, but can you see why I want to go define risk? Just like that, I can make $375 to risk $220, like my or $250 to make $375. Like automatically with defined risk, I can make it so maybe I get like 125, 130% return on capital. But now I have to play it out with like the timing has to be right. And that has always been like the hardest thing to do on the Japanese yen is time this crap. Because who knows? So we'll see. It is what it is. Could I trade this another way? Let's see. I could do a zebra, which would be super expensive. If I bought 2 contracts here and I sell a 50 delta right here. So the 6/6, I'm going to sell one of those. So this is essentially like being long the contract. I mean, I'm risking $4,000 on that trade. It's like, it's not worth it. I'm not taking that type of risk on the Japanese yen. So we'll see. Defined risk is probably the style. But to me, that's just way more flexibility than it would be if I just traded Forex. Because Forex, for the Japanese yen, my least favorite currency pair of all time, by far. All right, anything else? Let's go Swiss pairs. The Swiss cut rates, more than expected. I still like the positive swap. We're holding these levels on Aussie Swiss. I'm still holding long towards the 6,000 to 6,100 zone. CAD Swiss, we're hanging on those lows pretty nicely at 6,200, and hopefully we can get back through. I don't know. I mean, I still think that we may come back and revisit. We might revisit this flash crash low, which I would be interested in kind of buying. If this is a low and then a high and then a repeat of that low, this could be a double bottom that gets me back up to the center high. There's also a really nice pocket trade in here. So I'd have 2 big inefficiencies that I would be trading towards. So if I bought this thing around 6,000, okay, and I'm still going to hold this trade. I'm still long CAD Swiss. I've been long this thing since like 2023. I will hold this. And if I buy back in more at 6,000 and I add more to the upside and I get this thing back to a center high, that's a big winner. But also if I get that double bottom to play out, that's a massive winner. And it's just a technical trade. But a double bottom is this. We have a low, a center high. We'd have a double bottom here. You get back to the same center high, and then you double that move. There is so much reward to risk, right? You have all this potential profit for this tiny little risk right here. But yes, it's going to get messier and it might come back and, give you a bigger drawdown. But if the level holds in its support, then you've got a fantastic trade to the upside. Euro Swiss, looking better. That turned nicely off this 9,200 support. I'm holding this thing towards 99. I'm trying to get this thing all the way back up towards 1.00, but I would be happy here. We come back to this high, I'm happy. I'll make some money there. This structure is holding nicely. And if we break out of that, I think there's open space to get to 99. So another big position trade for me is going to be, I've held this Euro Swiss for a while. If I hold all this support and it finally breaks out structurally, it's really this simple. If the daily time frame on the Euro Swiss gets above the 200 moving average and we're holding these levels, don't be surprised to stack up some orders and see this thing hit 9,900 again. That's a big profit level. Could it go higher? Sure, maybe. 1.00 would be awesome, but I also see where price has been. I'm not trying to be greedy. So I'm going to hold on to that one and see if we hit 9,900. Pound Swiss, it's finally showing signs of a potential breakout. I hope that it does. If we measure a move up here, I'm trying to get back to 1,600 as step one, and then trying to get back to 19 to 1950 step two. This is my final target right in here. Around 1,900 to 1,950 is where I will be satisfied on my pound Swiss. Positive swap. I'm going to hang on to it. Okay, New Zealand Swiss, also a little bit beat up, similar to the Aussie Swiss. Maybe it pulls back and finds a double bottom here around 5,000. But if we have some stacked orders here, trade goes higher, find me some 5,600. I still think 6,000. There's a nice level all the way up here towards 6,000. That could be wishful thinking. If we come all the way back down to revisit the flash crash, that to me is a double bottom potential. There's a center high. Measure the move up there. That's target one. Measure that move there, target two. Big opportunities, but my gosh, I can't imagine that this trade that I think has pretty good technicals has taken, almost 2+ years to fulfill. So if I go into 2025, I've literally been in these trades since 2023, right? Like, is it frustrating? Like, yeah, we haven't had really the technical movement, but at the same time, it's like, well, I mean, I'm getting positive swap. I don't know what else to say. It's like my drawdowns are very manageable. My swap is covered a lot of that. So I mean, I'm just waiting. And I'm sitting on like hundreds of thousands of dollars in profit. That's just, if it pays out, it'll be an awesome trade, but it is taking a lot of time. So I'm extremely patient, and hopefully that patience ends up benefiting. Okay, dollar Swiss looking better. My dollar Swiss, I'm trying to get this one up to 92. I'm looking to cash in on 25 plus positions. That's it. Like, I'm letting it drift at this point. We get up to these highs. I'm taking profit at 92. If it goes higher, there's still a huge pocket up here, but I'm not going to be greedy. All this is range bound for me. So if we hit 92, I'm happy. Okay, that's all my Swiss pairs. Yen pairs, I could care less. I'll trade Japanese yen futures. Looks like some other currency pairs. Aussie CAD, I'm still long. Aussie New Zealand, I'm still long. Aussie dollar, I'm still dollar cost averaging in. I'm taking some small stabs on the dollar or the Aussie dollar. Let's see here. No yen crosses. Swiss yen, that's the only one I'm holding right now. It's break even. Euro yen, nothing. Euro Aussie. I don't know. I mean, I missed the trade. The trade on Euro Aussie was down here. I'm not that interested. There is potentially a trade up into this resistance. I just don't know if we're going to go. This could be a range. Like, just be careful. This could be a range. Okay. If we see a weaker Aussie, and your proxy would be Aussie dollar. If the Aussie dollar keeps going down, then this Euro Aussie, might keep drifting, but I'm not chasing that thing. So I don't like it. I'm not doing anything on it. EuroCAD, I'm not going to do anything with this outside of maybe an opportunity to fade this high right there. So if we come all the way back to 5,200 and we respond to that resistance again, I would look for a short opportunity with a tight stop loss. That's about the only trade I see on EuroCAD that I like. Otherwise, I'm out. I didn't buy this, nasty dip. We came right back down. I didn't get a chance to short it really. It's like I never had a pullback that I wanted, so I'm not doing anything in EuroCAD. Euro pound right now, I'm still long, but I don't know. Just hang on to this a little bit longer. Euro New Zealand, similar to Euro Aussie, possibly has room to get back into the 8,500 zone before we can top out. I'm not chasing this up. I would just be waiting for price to see if we hit resistance. We hit resistance for a sell. We hit resistance and top out for a sell. That is a 78 to 80. I mean, that's almost 1,000 pip range. And I thought for a second when we were actually heading lower that we could get back down. This is a much more attractive buy level for me, right? 76 to 75 was a great spot to buy support. We just didn't get it. So now it's like 84 to 86 looking for resistance and see if that's a sell spot. In the middle, Either trade what you see and follow the trend, or wait for highs and lows to hit, and buy low, sell high. Euro dollar, I wouldn't touch this thing at 105. I don't think that level is firm enough to hold. I really don't. So I looked at this as an opportunity to sell more. Want to take this into parity or lower. I could see the dollar index getting stronger. I could see the euro dollar as mainly the correlation getting weaker. But I will say that if this runs to parity or runs back into the 90s, like we had a 96 low, I wouldn't necessarily buy it at parity, but I would say if we crack parity, I'm interested in small trade at parity, maybe a 9,800 and a 9,600 trades 2 and 3. I would dollar cost average in on the euro dollar at 20, 30-year lows and see, okay, did the dollar have enough fun? We go from 112 all the way down to 95. I could see the market responding to that in some degree. But at this point, I mean, I still think short is fine. There might be some manipulation here, so be careful, but just watch the structure. And if we break and go lower, dollar strength probably prevails, and we're maybe revisiting parity again. So it's a trade. But to me, am I going to trade the noise in here? Probably not. I'm honestly probably just going to wait for parity and dollar cost average in, get some small trades in, and then stack my orders back up and take this thing to 105, and that's where I make all my money. I test, let's say 1 to 3 levels here, and then I stack, let's say 3 to 5 levels here, and that's where my money is made when we get back to 104, 105. That's my trade. So I don't care what the euro dollar does. I just want it to come to a level that I'm more interested in trading with oversold conditions and divergence, and I can buy low and then take this thing with a big liquidity hunt. Pound Aussie, pound CAD, probably similar. Pound Aussie still going higher. You're either following the trend, you're not. I wouldn't fight that. Pound CAD has also revisited recent highs. I'm not fighting that thing. Don't fight it. Right now, look, it's at the end of the year too. Don't call tops and bottoms on these markets. Okay. What is in motion stays in motion. Don't call tops and bottoms in the currency market. What's already established is probably still going. Okay. Pound New Zealand's, we're moving up the highs. Don't fight this thing. So I'm not trading it. I've got nothing on it. I'm just either following along or not. Pound dollar, I got out for a small loss, and we'll see what happens. Pound dollar is definitely vulnerable below 2,600. We get below 2,600, we could quickly go to 2,000. If we hold here, I still don't know if that's enough to maintain pound strength. I don't know how the dollar would turn, to be bearish and the pound's coming out ahead. Outside of the fact that the BOE is maybe holding rates higher, but I don't think the carry trade matters that much. If the dollar gets stronger, this thing's probably going lower. So it's vulnerable. I got out on this little retracement. We came back to the 200. I took a small loss on that for 30 pips, right? But if we break below 26, we probably have room to get to 2,000. Okay, that's also a nice big psychological number, as is 3,000. So I would wait and see if we break 26 into the new year, and then maybe have a good trade to the downside. Okay, New Zealand CAD, I'm still holding long to get back towards 87 to 8,800. New Zealand Swiss, I'm long. New Zealand dollar, I've got a couple of scaling levels on New Zealand dollar. Small right now, testing levels, and I'll wait. So if we come back in and test, we hold this multi-year support, we get back into this level, I can take a break even and then a win and then a win. Those are supposed to be W's. So I could win 1, win 2, take a break even on this one. If I want to hold it a little bit longer, I just go from this high to this low, take the midpoint, and then say that's a profit target, right? Market's been responding to that level multiple times. It could do that again from support. So maybe we can get back to 6,000 as a profit target, which gives me, 3 winners on these small orders. But on top of that, if I like the trade enough to get a bounce, I could also stack these back up to the upside and try to get to 6,000 and turn it into a bigger winner. But I'll wait. Okay, dollar CAD, I'm still long. We're trading at 43.15. I did finally get taken in on that final stack in order. I have added in, so 1, 2, 3, 42 is filled. I stacked in at 42, 42.50, and 43. So I now have 1, 2, 3, 4, 5. I have 7 orders in. I have 7 orders in. If we get to 44.50 to 45, I'm taking profit, and I'm good on that. So dollar CAD is doing what I said. We've got a multi-year breakout. We broke above that 39.50 to 4,000. Don't fight it. There's not even a pullback. If it pulls back, so be it. I'm still buying this thing. This is going to go back up to at least a measured move at 44.50, I think. and trying to get back to these recent highs in 2016 to 2020, 4,600. So if I want to be greedy, then yeah, I'd like to hold on to this at 4,600. But what I'm doing instead is I'm being conservative. There's my measured move. There's my projected symmetry. I'll take my profit before that gets hit. Okay. How did you know dollar CAD was breaking above 139? Well, if you look at price, this was resistance. This was resistance. And what did price do? It kept going higher and higher and higher, and there was no sign of stalling, and it broke above 140. So how do I know it broke above 139? Price was at 140. That's a pretty easy indication. Price was way above the resistance. Okay. And it went all the way up here to 141. I'm like, that is not a fake out trade, right? This is in the heart of Q3, Q4. This is during a trending window. And CAD's weaker, dollar stronger. I just thought fundamentally, and also oil's been just sitting here like getting beat up like crazy. So, oil's not getting any love. CAD's not getting any love. Bank of Canada was way more dovish. And it was a pretty easy trade to see it broke, 50 to 100 pips above my resistance zone. And I just stayed with it. So that's why I'm long. And hopefully we're, talking profits here at 44.50 to 45. I might end up moving this up a little bit. But like I said, I'd be happy enough just taking profit for another, I don't know, maybe another 120, 130 pips. It's a good trade. Okay. All right. Dollar Swiss, I'm still long, trying to take this one up towards 92. Dollar yen, who cares? Okay. So, all right. Covered all the currencies, covered dollar, oil, gold, silver, cover the markets. Here's where we are for the week. We're right in the middle. You've got highs from 3 weeks ago. You got lows from 3 weeks ago. This market's sitting right in the middle as we approach FOMC tomorrow. Don't be surprised if the Fed, with tomorrow's price action, is sitting right in here. That 6,100, that 6,000 on the SPX, or the 610 to 600 on the SPY. Look, tomorrow's FOMC, everybody knows the rate's going to get cut. The Fed has been so transparent that CME Watch tool is spot on. The probability is like 90+% the Fed's going to cut. What they say, does the market care? Is the market going to care enough to react to it tomorrow? I don't know. I would say that if Powell wants to set the market in motion for another all-time high, then the Fed will do it, right? And the Fed doesn't necessarily do it, but it's like the market's just like, okay, we get it. We'll wait, and then we'll surge, right? Like the market is just waiting for the Fed to be a catalyst to then drive the market up higher. That's very possible. If the Fed says something that the market doesn't like, then perhaps we get a, breakdown below 6,000 on the SPY, or I should say 6,000 on the SPX, or 600 on the SPY. Something tells me that the market's not really going to care. It's trying to get every ounce of gains that it possibly can. And if it does, then we're going to hit, 59 all-time highs for the year, maybe 60 all-time highs for the year. Maybe the Qs hit some new fresh all-time highs as well, and enjoy the melt up while it lasts. So am I bearish going into Q1? No, I'm not, but I am hedging just in case. Okay. So it's pretty simple. Either tomorrow's Fed is really noisy and nothing really happens, and we stay sideways for the holidays, or the market's able to just kind of eke out these tiny little slivers higher, and everyone's just like, all-time highs, baby, all-time highs. It's fine. So if I were to put a probability on it, either sideways or up is probably the higher probability. Path of least resistance is likely the thing. Okay. The only real derailment that I have is if the Fed really acknowledges inflation tomorrow and they talk about a reason to be satisfied with the current amount of cuts and being very cautious moving forward because they've seen higher inflation data. That might be the only thing that maybe gets the market like, wait, what? Wait, huh? It's not up, not all-time highs, but I would see sideways to higher as the bigger probability. Unlikely we go down. At this point of the year with thin volume, unlikely to have like a big nasty correction. It happened in 2018, end of the year. Unlikely though, So I would say either sideways or higher, watch price. If we're greater than 6,100, if we're greater in the SPY than 610, melt ups. The previous all-time high was 609 and change. We get to 610, that's a new all-time high. That's 58 for the year. If we drift up through Christmas and New Year's, we get 59, 60, 61 all-time highs. Enjoy it. Okay. All right. Yeah, I know. The Fed is going to cut. It does not guarantee anything. It is either an excuse for the market to be noisy, an excuse for the market to do the same thing it's been doing for the last several months. But I think the higher probability is we're going either sideways or up as opposed to a full-on correction. I don't think the correction comes the last 2 weeks of the year. I mean, you go into the calendar, it's like Christmas Eve, Christmas Day, limited trading, New Year's Eve, New Year's Day, limited trading. That would be a huge surprise to the market if we're going to have a big, like, 3, 5, 7% correction last 2 weeks of the trading year. Unlikely. So just be expecting noise tomorrow. And then as the dust settles, here's what I would say. Here's what I wouldn't mind. I wouldn't mind this. Come down in and test 6,000 on the SPX or 600 on the SPY and put in a bull call spread and trade this thing up to the rest of the year, right? Just use structure, find a low there. The market holds 600 and then goes all the way back up to the highs. Easy income trade, and you get a little bit more of them. But I'm still looking at the major level support. I think we're going to find it, or the market's going to go either sideways and be noisy, or it's going to drift up higher. There's still order flows going into the markets, right? Everyone's buying Mag 7. There's a lot of money in the markets. There's a lot of money out there that's being added into it. There's been a big pump post-election. Everyone's optimistic about 2025. So, am I overly cautious? No, not overly cautious, but I'm just ready for a little reality, but I want to be buying. Like, that's the thing, is like, I'm just waiting to see, like, can I get a dip to buy? That's all I'm waiting for. And so I'm like a little cautious going into, like, I hope we have a pullback. Because if we don't, okay, fine. But if we have a pullback, it's good. Okay. But most likely path of least resistance is probably going to be the winner. So I would not be surprised if I get a trade this week. It's going to be bounce, looking for longs, and I could look for a bounce on the SPY, bounce on the SPX. I could do bull call spreads to make it risk defined, and try to get an income trading by the rest of the year. If we get to all-time highs, I've got some of my strategies that are also going to be, generating some profit there. That'd be another like 4 winners probably, and that's it. And what I'll end up losing on are hedges. But I've got hedges out to December 31st. I've got hedges right now out to the 31st of January. And as we roll into the new year, I'll probably put hedges out to the end of February, and then the end of March, and then the end of April. And I will keep doing this like a fool. And eventually I'll, maybe have it pay me. But all this is if I can get, let's say 2 to 3% gain on the upside while sacrificing 0.25%, I'm okay with that. Like, that's my insurance cost. If auto insurance is 61% more expensive than it was, I can afford to pay 0.25% in portfolio insurance. How's that? Okay. All right. All right. I'll let you go for today. Let's see here. Tomorrow should be good for tomorrow. Yeah, tomorrow should be good in the morning for the typical A1 trading session. And then I should be joining Nick and maybe Nick and Frank if we're doing an FOMC session around 1:30. And we'll see where the fireworks get us going into 2 o'clock with the rate decision. But it is expected to be a rate cut. It's pretty much been priced in. We're at 95+%. This is transparency. This thing has not been wrong since 2009, so pretty reliable. And we'll see. Just keep in mind on Wednesday, FOMC rate cuts expected. Watch the U.S. 10-year yield. And then also on Friday with PCE, is the year-over-year higher and hotter? If it is, it's clearly 3 months of data that is showing higher inflation. The Fed can't just freaking ignore it, okay? And going into 2025, it would give the market reason to believe like the Fed is not going to be as crazy dovish. It's already pulled back on like 40 to 60 basis points of cuts in 2025. I think the market might be lucky to get 2 cuts next year. That cut is probably not coming in January. That's going to be maybe a March and July. I don't know. We'll see. But Q1 is going to be an important kind of inflation quarter for the U.S. because if we have tariffs hitting in Q1, that's probably not a good thing. PMI numbers are up. We get a bigger announcement from China in March of 2025. That's more inflationary as well. So we'll see. Right? All right. That's it. Stay frosty. All right. See you, everybody. Have a good day. Bye.